Hi, this is Wayne Zell, and welcome to Blueprint for Wealth's educational moment. Today, we're going to talk about when should you sell a piece of your company to a non-grantor trust. What's an installment sale of a company? How does it work? Well, in an installment sale, you could sell part or all of your business to a trust for the benefit of your spouse and family for a promissory note that bears interest only, with the principal amount becoming due at a specified maturity date in the future. Depending on the duration of the note, the IRS's applicable federal rate would determine the interest rate. And while the note may or may not be secured, it has to be enforceable under local law. What's an example of an installment sale involving a business? Well, one example may be where you're selling an appreciated business interest either to your kids or your heirs directly, or to a non-grantor trust established for the benefit of your children or heirs in a taxable installment sale. What's the advantage of selling to a non-grantor trust? Well, at least one advantage of selling to a non-grantor trust is that it allows you to lock in the capital gains at a fixed value while deferring the recognition of gain until payments are made under the promissory note. This strategy effectively transfers the appreciation in value to the trust beneficiaries. How is the tax handled for interest and principal payments that are received from the buyer? Well, interest that's received from the buyer is taxable at ordinary income rates, which can be as high as 37% federal. On the other hand, principal payments are subject to tax as long-term capital gains, which might include a return of capital, but only when the principal payments are actually received. What's the difference between using a grantor trust versus a non-grantor trust? If you sell the business interest to a grantor trust, which means that the income of the trust is taxable to you as the grantor, the sale is ignored for income tax purposes. In other words, the trust doesn't pay income tax, you do. So you're treated as if you're selling the interest to yourself. But in a non-grantor trust, which is treated as a separate taxpayer, the note will allow you to defer income tax until the installment of interest and principal payments are received. One main exception to this rule is when the buyer is related to the seller and sells the assets within 2 years of the original purchase. In that case, the gain will be accelerated. If you want to know more about sales to non-grantor trusts, grantor trusts, or trusts in general, contact us at zelllaw.com. And if you want to read more about some of these techniques, you should check out my book, Your Multi-Million Dollar Exit, which is available on Amazon as well as at waynezell.com.